the incredible strength that we have seen in the highly skilled sector, the fact that, as an example, Silicon Valley can take 10,000 layoffs from some of the tech giants and absorb those workers in 6 weeks has really impressed me.
Step into the world of financial wisdom with renowned investor and credit analyst Rick Raoul. In this thought-provoking video, Rick unveils his intricate understanding of the current economy, tackling subjects from the impact of higher interest rates to the shifting job market and the intriguing behavior of gold prices. His astute analysis and profound insights provide a fresh, compelling perspective on the complex financial landscape we navigate today. Expect to have your understanding of economics enriched and your perceptions broadened. So sit back, tune in, and immerse yourself in this captivating exploration of finance with Rick Raoul.
The strength in the economy, even in the face of higher interest rates and a higher cost of capital, has been a real surprise to me, and frankly, a very pleasant surprise. I had expected much more trying times in 2023 than I've experienced. I'm nervous that the economy will perform the way it did in the first decade of the 1970s, the first half of the decade of the 1970s, where the economy in the early part of the decade of the 1970s was able to stand both inflation and higher interest rates. But then the impact of higher interest rates in particular was felt in the middle part of the decade of the 1970s. Again, I'm not an economist, I'm a credit analyst, and I make this up, Kai, perhaps to explain circumstances that I don't understand fully. My nervousness is that the impact of higher interest rates will be a delayed punch. As an example, in the United States, despite the fact that 30-year fixed mortgage rates are up by more than 100%, you aren't seeing widespread decline in home prices. What you're seeing is a broad decline in volume, which is to say, the buyers aren't willing or aren't able to pay as much as they were willing to pay 2 years ago, but the sellers' expectations are sticky. There's bigger gaps between the bid and the ask. I guess that resolves one of two ways, up or down. My nervousness is down. But again, I'm not an economist. I'm a lender. And so perhaps my worldview is shaped by what I do. The job market is incredibly buoyant. And I take some solace at that. It's interesting that the job market is buoyant only in two sectors, though. Low-wage service, where unskilled or semi-skilled workers generate such limited utility that they can't be paid living wages. That's booming. And then the highly skilled sector, the sort of 150 to 350,000 a year jobs that generate a lot of utility that require a lot of expertise. The incredible strength that we have seen in the highly skilled sector, the fact that, as an example, Silicon Valley can take 10,000 layoffs from some of the tech giants and absorb those workers in 6 weeks has really impressed me. I'm impressed, too, with the durability of the job markets in finance, both in equities and in credit. I would have expected Wall Street, in terms of hiring, to be much softer than they've been, but that hasn't been the case. I live in rural Northwest Washington, and the little community that I live in is experiencing such extraordinary labor shortages that, as an example, Safeway is paying people $20 an hour to start. The police department is paying people a $7,000 or $8,000 signing bonus, or a $30,000 bonus for a lateral transfer. There may be recessions in subsectors and in some regions, but I'm incredibly impressed with the strength of the economy, and not just the U.S. economy, the European economy. challenged by much, much, much higher social and energy costs, and challenged too by what, if it isn't a war, is a very ugly police action in the Ukraine. I would have expected the Eurozone to be in much worse shape economically than it is. Even Germany seems able to afford hyper stupid energy policies and appears to discount the challenges on its eastern and southeastern border in terms of sentiment. So I need to say that I, thus far, with regards to my own excessive cautiousness, have been wrong. I think that may be the reason that gold is hanging in there. I think the reason that gold hasn't soared, frankly, is that we were schooled by 40 years of benign economic climate, beginning in 1982, and I would suggest ending in 2022. So I think that confidence is quite high. While I'm attracted to the performance of the broad economy, I am not attracted, but rather terrified when I look at collective, which is to say government balance sheets. We've talked about this on your show before. The strength of the U.S. economy has not translated into covering the budget deficit, as an example, or dealing with the debt. And that circumstance is the same in Europe. I think that increasing nominal interest rates has made short-term deposits more attractive. And I think that that has detracted from acceptance of precious metals. But I think a much more important reason is that because all of us were schooled in terms of our investment performance and expectation by 40 years of benign economic climate, which is to say we've been schooled not to become scared. I may be excessively scared, but when I look at gold and I think about the fact that, as you say, it's, quote, held up, I am really surprised that it hasn't gone further faster. When you talk, as an example, about real interest rates, understand that I would define a real interest rate as a rate paid as rent on savings that exceeded the depreciation of the currency that the savings were denominated in. And the forward-thinking measures of inflation, I think, are very misleading. As an example, when it suits them, they describe core inflation, which doesn't include food or fuel. As your listeners can tell by looking at me, I like to eat. And so that definition of inflation doesn't apply to me. But two, when they talk about CPI, Consumer Price Index rate of inflation, they're really trying to construct a cost of living index. And the fact that inflation doesn't include the cost of government, which is to say tax, which consumes more household income on average than food, energy, shelter, and travel combined, you truly have a fallacious index. And I guess that one of the things that has, I think, kept down the gold price is that consumers and investors and taxpayers have come to allow their interpretation of inflation, to be shaped by what is frankly a fraudulent method. When I look at the impact of increased taxation and the certain threat of more rapidly increasing tax on my budget, I understand that the stated measure of CPI has in no way measures my own cost of living. Now, Kai, if I didn't have to pay the tax, I probably wouldn't complain so much about the index. But I suspect that very much like in the 1970s, as people come to understand the impact of the deterioration of the purchasing power of their savings, that people will become less wedded to interest yielding savings products and more interested in investments that traditionally have offered better shelter from inflation.